Renting to a family member has many advantages. Most importantly, your tenant will be someone you know and trust, so the due diligence has already been done. Secondly, it's likely to strengthen family ties by setting up a mutual support system, one that is particularly beneficial to older family members. Uncle Joe will undoubtedly take comfort from knowing that he has familial ties to his landlord. You, on the other hand, can rest assured your property is in safe hands. Third, it's good for your property since both parties will have the common objective of maintaining the property in good shape. And last but certainly not least, there are tax benefits. We'll get to those tax benefits in a moment. But first, let's look at how the IRS classifies property, because that classification is what determines the way the property is treated tax-wise. The first thing to know is that your property may be considered a residence, rental property, or vacation home. Each of these classifications has a different tax implication, so misclassifying property could cost you a pretty penny. Nevertheless, deciding on the classification is simple enough. The determining factor is the use of the property. So let's see how this works. A property is considered a residence if you use it exclusively for personal purposes. In other words, it's your home. You live there. If you itemize your deductions on Schedule A, Form 1040, you'll be able to deduct your mortgage interest and property taxes, plus a few other items, such as casualty losses from federally declared disasters and improvements to the property made for medical reasons. In this scenario, no one is paying you to use the property, so it doesn't even earn any income. Rental properties are properties that are held to generate income. Instead of you using the space to live in, you rent it out. Thus, the rental properties are businesses. This means they're entitled to the same accounting and tax treatment as any other business. That includes being able to charge all business expenses against revenue. These expenses may include mortgage interest, property taxes, casualty losses, maintenance, utilities, insurance, and depreciation, among other deductions. These expenses will reduce the amount of rental income that's subject to tax. You'll be pleased to know that your deductible rental expenses are allowed to be more than your gross rental income, which means you'll have a loss. However, note that any rental loss will be limited by the at-risk rules and/or the passive activity loss rules. Don't worry, we'll discuss those rules later in the video. Vacation homes are second homes that are used both as residences and rental properties. In general, homes that are used mostly for personal purposes are residences, while those used as a source of income are rental properties. For starters, if you rent out the property for fewer than 15 days, you don't even have to report the income. The property will be regarded as a residence and the residence rules will apply. The property will also be considered a residence if you use it for personal purposes during the year for a certain number of days. That's more than the greater of either 14 days or 10% of the total days you rent it to others at fair market price. So a property would be considered a residence by the IRS if, for example, you use it for personal purposes for 25 days and you rent it out to others at fair market price for 200 days. That's because 25 is more than 10% of 200 and is greater, of course, than 14. Note the requirements that any rental must be made at fair market price. A little later, we'll explore that concept further. On the other hand, if a property is rented out more than 14 days a year and personal use is limited to fewer than the greater of 14 days or 10% of the days rented, it is treated as a rental property for tax purposes. Owners can deduct expenses such as maintenance, insurance, depreciation, although passive activity rules may apply. However, to ensure you get those tax benefits, you must comply with primary residence and fair market value rules. It's important to know the property rented to your relative must be their primary residence. This means that the relative should live there for most of the year as their main home. This arrangement is important because it helps avoid the personal use designation, which could limit your ability to deduct expenses in the property. The first rule is rent at a fair market value. Let's see why this rule is important by examining its tax implications. Dr. Sarah is a vascular surgeon. She owns a 3-bedroom investment property which she rents to her brother Tom. Dr. Sarah charges Tom a rent of $1,200 a month. However, the rent for similar properties in the neighborhood is $2,000 a month. Expenses for the property total $16,000. Since Sarah is charging below market rent to a family member, the IRS may treat the property as being used personally rather than as a rental for tax purposes. That is unless the rent is at least 80% of the fair market value. In this case, Sarah is charging only 60% of the market rent, which is $1,200 divided by $2,000. This is below the 80% threshold, and so the property will be considered as being used for personal purposes. As a result, Sarah's ability to deduct expenses is limited. She may also only be able to deduct expenses up to the amount of income she receives from the rent, which is up to $1,200 per month. This is so even if her total expenses exceed the amount. So the tax outcome for Dr. Sarah is rental income is $14,400 per year, expenses are $16,000, but only $14,400 is deductible in the current year. However, the excess $1,600 can be carried forward and applied to reduce rental income and other passive income in a subsequent year. Renting to a family member at a discounted rate below the 80% of market rent converts the property from being a rental property to a personal residence for tax purposes, which limits the amount of deductions and may result in a less favorable tax treatment. What's the situation if Sarah charges Tom a rent of $1,700 a month? Sarah charges Tom a rent of $1,700 a month. The IRS will treat this arrangement like any other rental property transaction. And that's because the rent now represents 85% of the fair market value, which is above the 80%. The fact that the tenant is a family member does not affect the tax treatment as long as Sarah charges at least 80% of the fair market value. Because the rent satisfies the 80% rule, Sarah can treat the property as a rental for tax purposes. This means she can now deduct all the expenses associated with the rental property, including mortgage interest, property taxes, insurance, repairs, maintenance. In addition, she can also claim depreciation deduction for the property. So let's assume expenses are now $26,000. Sarah receives $20,400 in rental income for the year. Since the property is treated as a rental, Sarah can deduct all $26,000 of the expenses, resulting in a $5,600 loss for the year. Since Sarah's deductible expenses exceed the rental income, she may be able to use the loss to offset other income, provided the situation satisfies the passive loss limitation rules. The new tax outcome for Sarah is rental income of $20,400 per year, $26,000 of deductible expenses, which include mortgage interest, taxes, repairs, and even depreciation. So that net loss is $5,600, which may be applied to other income subject to passive loss rules. So by charging Tom a rent that satisfies the 80% rule, Sarah can treat the property like any other rental. She can fully deduct the expenses, claim depreciation, and potentially deduct rental loss, just as if she rented to a non-family member. The fair market rule also applies to rent subsidies, which you may consider when renting to a relative. Rent subsidies can play an important role in supporting the tenancy without violating tax guidelines. The two main types of subsidy are good tenant discounts and direct rent subsidies. A good tenant discount typically involves providing financial support or concessions based on a relative's status as a responsible tenant. This might include occasional waivers for minor repairs or temporary leniency to rent due dates. To avoid IRS scrutiny, it's important that any subsidies offered do not impact the fair market value of the rent. For example, offering a small, reasonable discount for one-time payments may be fine, but significant or ongoing subsidies could result in personal use, reducing in allowable deductions. Rent subsidies are direct reductions in rental amount that result in the rent being lower than the market rate. However, to qualify as a true rental activity, the IRS requires the rentals, even to relatives, to be at fair market value. At below market rent classifies the property as personal use, limiting deductions mostly to property taxes and mortgage interest. Ordinarily, the loss in one year is carried forward and applied against income to future years. However, it might be possible to apply that loss in the current year by satisfying the active participation rules or becoming a real estate professional. Let's take a brief look at the passive activity loss rules. While we do that, we'll also touch on the at-risk rules because the two sets of rules are related. The at-risk limits and the passive activity loss rules are both designed to prevent taxpayers from using losses from certain activities to offset income from other sources unless specific criteria are met. However, they restrict the use of losses in different ways. At-risk limits restrict the amount of loss a taxpayer can claim to the extent of the actual economic investment. In other words, you can only reduce taxable income by the amount you have risked in a business activity. So for example, if you invest $100,000 into a rental property and the investment is funded by $40,000 of your own money and a bank loan for the rest, losses can only be deducted up to $40,000. That's because you only have $40,000 of risk in the venture. Passive activity loss rules apply when you have both passive and non-passive income. Rental activities are generally considered passive activities under IRS rules, meaning any net losses from the rental property can only offset passive income. Income from other rental properties or businesses in which Dr. Sarah does not materially participate could be considered passive income. However, there are exceptions that might allow Sarah to deduct the rental losses against her non-passive income, such as her salary from her day job. The two key exceptions are if Sarah actively participates in managing the rental property, she may qualify for a special allowance to deduct up to $25,000 in rental losses against non-passive income. An example of non-passive income is the salary from her day job. Active participation does not require Sarah to do everything herself, but she needs to make management decisions like approving tenants, deciding on rental terms, or making repairs. However, this benefit has an income limitation that affects many healthcare professionals. The deduction starts phasing out if Sarah's modified adjusted gross income exceeds $100,000. If her modified adjusted gross income exceeds $150,000, she can't use any of the $25,000 rental loss allowance. However, if Sarah qualifies as a real estate professional, she can fully deduct the rental losses against her non-passive income without the $25,000 limit or income cap. To qualify, Sarah must spend more than 750 hours per year in real estate activities and more than half of her total working time in real estate. This status is usually harder to achieve if Sarah has a full-time day job outside of real estate. Renting your property to a family member can strengthen trust and family bonds while ensuring your investment is well cared for. However, to maximize tax benefits, it's essential to follow IRS guidelines, like charging fair market rent and meeting active participation or real estate professional requirements. When done right, renting to family can provide both relational and financial rewards. So, are you ready to strengthen family ties and maximize financial gains by renting to a relative? We can show you how. Subscribe for more insights, and let's make sure you're getting the best of both worlds.